Morning, everybody. Thank you all for being here. So today we're going to talk a little bit about the impact of the frequency of financial reporting on the idea of short-termism. For you guys that have been around, short-termism, it's a pretty prevalent topic these days. So the project's objective is to really understand how the frequency of reporting is going to be balanced between transparency, the effects of short-termism, and obviously there's a lot of regulatory implications that come with it. Now, when we talk about short-termism and frequency of reporting, what you're really assessing is how often do firms report and what is the impact on investors and their decisions, right? Because investors will act on just about any information you give them. And in the US, we have a quarterly reporting system. So constantly, firms are putting out information, investors are going to act on it, and firms are going to do everything in their power to get investors to act in the way most beneficial to their business, right? And this poses some risks, but just to talk briefly about the benefits. For investors, this reduces asymmetric information. They get more information to act on, and they have a less risk with regard to making decisions on things they don't know about, right? And for managers, this is going to lower the cost of capital. In essence, investors are going to perceive less risk related to the firm now they know certain things that are coming out, right? This will improve analyst forecast accuracy, market efficiency. Obviously, the less asymmetric information we have, that's a better thing for the markets. And obviously, just transparency in general tends to be a good thing. Now, that's all in theory, but there are some drawbacks to reporting so frequently, right? And so there's this vicious cycle that I briefly just talked about, that we're going to have reporting pressure. There's going to be a focus on beating or meeting the quarter, and in this case, firms tend to cut investment, cut R&D, research and development, and that's not necessarily a good thing for a long-term focus and really the efficiency of our capital markets. Right. And it doesn't, you see this circle here, this cycle, the arrows don't stop. There's quarter after quarter after quarter, and firms will, with the right incentives, continue to act in a short-term approach, which, like I said, not very good, right? And this contributes to a number of things that honestly impact smaller firms the worst way, because compliance costs will go up. Now, for these bigger firms, not as big of an issue, but like I said, smaller firms, this is a lot to them, right? This also contributes to a lot of market volatility because, like I said, investors will act on any information you give them, and they tend to overreact quarter over quarter, which again does not really contribute to an efficient capital market. We don't want to see that volatility, especially if it's an overreaction, right? And we'll talk a little bit more about how guidance comes into play here a little later in the presentation.
Thank you, Michael. As you mentioned, in theory, quarterly reports has been well known and accepted by big cap firms, especially in US, and it's supposed to improve capital allocations and foster accountability. However, the evidence has shown some discrepancy regarding that. There's a lot of earning manipulation, reduced investment, and lower innovation. For example, when you want to for your quarterly reports, if you want to beat revenue, the easiest way to do it is to cut down on investment in, let's say, new AI or investments in new capital. And that does help your short-term quarterly report. You can beat your earnings per share, and investors are happy about it. But in the long run, if you think about it, if you fail to invest in AI, what is the long-term consequences? It's very hard to know, and also it's just not a good habit of cutting investments. As shown by Bouchier, institutional investors, short horizon pushes firm, and there are a lot of investors pressure that really pushes I want you to perform better in this quarter, so please cut on R&D or do something. And firms tend to slowly forget their long-term horizons while focusing on short term. More frequent reporting also has lower cost of capital, which is also this also varies between different firms and different investor compositions. As you can see, it also enhances market efficiency, the theoretical benefits, but also in practice, when there's lower innovation and lower long-term investment, one may ask whether is this really beneficial. And other countries have taken this differently. For example, in Europe, actually, there used to be a requirement for a quarterly report, but the EU regulators realized that it was creating huge pressure for these companies to try to pump up their earnings. So they repealed it in 2013, and overall, in general, has shown a positive impact in their long-term growth. In Singapore, the reduction of quarterly reporting led to a quality reporting requirement actually led to a 5% drop in firm value, particularly for firms disproportionately affected by the compliance costs. As Michael mentioned, especially for small firms, having accountants and auditors keep checking over your books, it leads to high compliance costs. And in 2020, Singapore, it removed the mandate, saying they need to reduce this unnecessary burden. Last but not least, in USA, the SEC has moved from annual reporting in 1970, but a lot of studies have shown has been slowly linking long-term investment in R&D and reduce the reduction of that due to core reports. And even companies like Berkshire Hathaway and guidance have opted for minimal guidance, we'll discuss later. And we further discuss how guidance also plays a role in this short-term behavior and how some companies are showing inclination that they want to reduce the level of short-termism, with example of Google.
In addition to financial reporting, earnings guidance also plays an important role in shaping markets' behavior. However, it's important to know that offering guidance is voluntary and it's forward-looking, and it's typically a firm future projection of its earnings per share or revenue. While it's not required like financial reporting, it's still often expected by analysts. So one main benefit of offering guidance is improved forecasting accuracy, but there comes a trade-off. High-frequency earnings often increase the pressure on managers to meet short-term targets, and this often comes at the cost of sacrificing longer-term strategic investment like R&D. To manage this, firms often take a moderate approach. In other words, a lot of them would choose to underpromise in order to beat expectations later on. Over time, many firms have chosen to either reduce or eliminate quarterly earnings guidance altogether. And this would oftentimes attract longer-term investors who are less focused on quarterly fluctuations. As shown in the chart on the right from FactSet earlier this year, the percentage of S&P 500 firms offering EPS guidance has actually fallen sharply. So from around 50% in 2004 to just 21% last year, signaling a shift, a broader shift away from short-term forecasting. One of the most notable examples in the shift is Google. When the company went public in 2004, it made a deliberate decision not to provide any quarterly guidance. In its IPO letter, its founders emphasized the company's focus on long-term value creation and innovation, rather than playing the short-term expectation game. Despite initial skepticism, as we all know that the company has remained quite successful, maintaining a strong investor trust and strong performance without issuing any guidance. It's important to note that quarterly reporting frequency alone doesn't really cause short-termism. The real issue really emerges when it's paired with earnings guidance and analyst pressure, which can oftentimes distort managerial behavior. A lot of firms would feel the pressure to meet or beat expectations, even if it means sacrificing longer-term goals. So the solution really comes in the balance. So there's not really a one-size-fits-all model. Each firm needs to find a right mix of reporting and guidance based on its individual investor size, industry dynamics, and its strategic goals.
When we talk about the policy dilemma, one of the main things that is talked about is the one-size-fits-all method, where in this, when you report the mandates, it may be extremely harmful as it's much more expensive for smaller firms in order to be compliant with all these costs, as shown in the case study in Singapore, where firms had a decrease of 5% in firm value. So what we came up is that companies should consider a hybrid approach, where there are semi-annual reports with qualitative interim updates, where we should encourage earnings guidance, but make it optional for companies to report it or not. And lastly, for this to work, we have to be able to scale the rules in order for it to allow for smaller firms to be able to deal with this. And regulations should reflect firm heterogeneity and investor sophistication. So to summarize everything up, quarterly reporting improves capital access to investors and also decreases the lower cost of capital required for investors to invest. But although they may have many benefits, there's many trade-offs. Over-reliance on meeting short-term targets can harm innovation and investments as companies are focused on purely meeting these deadlines set by the US government. Policymakers should tailor rules and encourage long-term investor alignment. And lastly, the solution isn't less transparency, it's smarter transparency. Thank you. I would like to take the time to welcome our panelists to the stage. Rob Robert Chosen and Paul Clancy. Chosen. I'm s- This is work. Okay. So I would like to give a small introduction for each of them, as if I give a proper introduction, I'll be here for hours. But Robert Posen is a senior lecturer at MIT Sloan School of Management and a non-resident senior fellow at the Brookings Institution with a distinguished career spanning business, government, and academics. He is widely recognized for his thought leadership on productivity and financial policy, and is the author of several influential books, including the bestseller Extreme Productivity, Boost Your Results, Reduce Your Hours, and Remote. In the private sector, Posen served as the executive chairman of MFS Investment Management, where he helped grow assets under management from 130 billion to over 400 billion. Prior to that, he was the vice chairman of Fidelity Investments and the president of Fidelity Management and Research Company, overseeing a period of remarkable growth. His expertise has also been sought at the national level. He has served on President Bush's Commission to Strengthen Social Security and was the Secretary of Economic Affairs under Massachusetts Governor Mitt Romney. He later chaired the SEC Committee to improve financial reporting. He is currently an independent director at AMC, a World Bank subsidiary, and has previously served on the boards of Medtronic, Nielsen, and BCE. He also chairs the Leadership Council of Tax Policy Center and serves on the Council of Foreign Relations, among other leadership roles in financial governance. Secondly, Paul Clancy is a seasoned executive and board member with nearly 4 decades of experience across the biotech and consumer products industry. He currently serves on the board of directors of 4 leading life science companies, Insight Pharmaceuticals, Exact Sciences, Xilio Therapeutics, and Sionna Therapeutics, and contributes his financial expertise to the Finance Committee of the Catholic Charities of Boston. He has spent over 2 decades in the biotech sector, most notably serving as a CFO at Biogen from 2007 to 2017, and went on to serve as a CFO at Alexion Pharmaceuticals from 2017 to 2019. Earlier in his career, he held various roles in the consumer products industry, building a strong foundation in financial leadership and strategic planning. In addition to his corporate roles, he is also actively involved in academia. He teaches corporate finance to MBA students at Cornell University's Graduate School of Management and serves as an executive fellow at the Harvard Business School.
Can everybody hear me? So let me begin with a question. I'm going to ask for a vote as to what you consider long-term. We'll start with 6 months, then 3 years, 5 years, 10 years, 15 years. So we talk a lot about long-term here versus short-term. So I'd like to get the consensus view. So how many people consider 6 months to be long-term? How many people consider 3 years to be long-term? 1. How many people consider 5 years to be long-term? Okay, we have how many people consider 10 years? Okay, how about 20 years? So I think the median tends to be 10 years. So let's think about what it means to have reporting every 6 months and every year. So when people say they don't like quarterly reporting, what they're talking about is shifting quarterly reporting to 6-month reporting. So if you feel that quarterly reporting is too short term, there's no one in this room who thinks that 6-month reporting is long term. So if you really wanted to promote long-term thinking, you would have to have reporting every 10 years, according to this room, or maybe every 5 years. But moving reporting from 3 months to 6 months, I would argue, has all the deficiencies of short term without any of the positives for long term, because 6 months isn't long term. And if you really were to shift a company's viewpoint from every 3 months to every 6 months, there's no one in this room, and I would agree with them, that would say that that's long-term thinking. It isn't. It's just 6 month thinking. It's a little less short-term than 3 months. But there's no one here who should think that the debate here is actually between short-term and long-term. The debate on frequency reporting is between 3 months and 6 months. So when Singapore went and changed its rules, it changed it from 3 months to 6 months. And people in Europe generally have 6 month reporting. In the US, we have 3 months. Now, I did a study along with two professors from Columbia Business School, which does not appear to be in your bibliography, uh, that looked at the UK experience. And the UK is illustrative because the UK started with 6 months. It then moved to 3 months. It spent about 5 or 6 years, maybe longer, with 3 month reporting. And then it shifted back to 6 months. So we had what we call in economics a natural experiment in whether this change made any difference. And we looked at research investments, we looked at earnings, we looked at all sorts of things, and we didn't find any significant correlations that changed. We didn't find any significant differences between people at 3 month and 6 month reporting. And my wife, who's a psychotherapist, said, of course, there's no difference between 3 months and 6 months. None of it is long term. So if you're looking, for instance, if you think you want to promote R&D investments, going from 3 months to 6 months doesn't do it because it's still very short term. So that's my view. And we have to see what are the negatives of being at 6 months instead of 3 months. Well, things happen pretty quickly. And companies' situations happen very quickly. And every country has a rule that essentially says when there's a material big event for a company, it has to issue a press release. And in the SEC, we call that 8Ks. So if you have 6 months instead of 3 months, you're still going to have events that occur. There are going to be a lot more of them that are going to occur between the reporting periods. So it just means you're going to have a lot more 8Ks, and you're going to have a lot more dark periods, and you're going to have a lot more periods in which there is a great possibility of insider trading because something will have happened to the company, but it won't have disclosed it. So there are real negatives of going to 6 months, but in my view, there are very few positives. If you really want to go to long term, we ought to go to 3 year or 5 year reporting, and then think about the length of the dark periods. I'll say one more thing before turning it over to Paul, who, coming from a company, I'm sure has a different view. I come from the institutional investor background. To me, if you want to encourage long-term thinking, you've got to look at executive compensation. And I've had lots of companies come in when I was at Fidelity and MFS and tell me they're long-term oriented or they'd like to be long-term oriented. The question is, what do they pay their executives on? And most companies pay their executives on the prior year's revenue, earnings, and various economic indicators. And it's not a 5 year basis. It's not a 10-year basis. So this room thinks that long-term is 10 years. So then in my view, if you want companies to think long-term, then the executive compensation should be based on the last 10 years earning. surely not on the base last 1 year earnings, because if you pay people on the basis of 1 year, it doesn't matter what you say. They understand that the compensation is very geared to 1 year, which this group, and I would agree, would say is relatively short term. And last point, third point, I'm been strongly against earnings guidance for many years. I think it's like people shooting themselves in the foot. That is, what we see is people, and it's been reduced now because people like me have lobbied against it. You're essentially saying my next quarter's earnings is going to be $3.23. Uh, or you're saying next quarter's earnings is going to be between 322 and 325. So that sort of earnings guidance just sets you up for the fall. Because if you miss that earnings guidance by even 1 penny, your stock will drop precipitously. So I don't understand why people would do that. And of course, the analysts ask for it because analysts are lazy. They want the companies to tell them how to focus, but they're supposed to be doing their job. Their job is to look at companies and make their own predictions of earnings. So I say to companies, try to not give earnings guidance, or if you have to give earnings guidance, say over the next year, our earnings will be in a broad range of, let's say, $3.50 to $3.60. So at least you're allowing for seasonal adjustments and you're allowing for a range of results. So to summarize, I don't think there's anybody in this room who's really for long-term earnings, because I don't think anyone here, are people willing to have earnings reports come out only every 5 years or 10 years? That's what you say is long-term. So if you think that what produces long-term behavior is the frequency of reporting, we're way off. We're talking about quarterly versus semi-annual, and it's irrelevant. It's irrelevant to what you have defined as long-term. Second of all, I suggest that the real key to getting people's long-term approach, executives, is how you pay them. And by the way, the prior speaker in the prior panel said that institutional investors pay their managers on a quarterly basis. That's not true. When I headed Fidelity, we paid, and it's still true, we paid our managers based on 3 years performance, the last 3 years, not the last year. So it wasn't perfect, but the reason we chose 3 years is that's about as long-term as most investors are willing to tolerate. Ask yourself, if a company is doing poorly and they say, don't worry, we're here in the long term, how long are you willing to tolerate that? Turns out that even patient investors lose their patience after 3 years. And finally, earnings guidance is really just a bad idea. There's no reason that people should do that. And if they have to do it, they ought to try to minimize its effect by doing it over a year and doing it for a broad range. So I'll stop there and turn it over to Paul, who I'm sure has a different perspective. I think you have to press this.
There we go. That should do it.
Well, you guys are lucky to have Bob here. He's been thinking about this issue for probably 20 years. So he's been thinking about this issue, and he's probably an expert on this issue for a long time. No pun intended. I totally agree with you, Bob, on the first 2 points. I want to kind of explore a little bit harder on the third. But let me start by kind of saying, I think it's important for students to understand that this kind of theme of chronic short-termism in the United States I think you want to double click on it and really understand it harder, because there's actually there's mixed results as it relates to this. It's hard to say Google, as you pointed out, Amazon, all kinds of companies aren't long-term oriented. So, and we have tremendous amount of companies that are incredibly long-term oriented and at the same time incredibly short-term focused. And short-term is a hallmark of industry, right? I mean, Amazon gets you your packages within 24 hours, right? So that's an example that I put in the category of execution, which is good short-term orientation. It needs to be coupled at the very top of an organization to be thinking about how do you evolve the company over a really, really long term. For anybody that's done discounted cash flow analysis, right? Raise your hand if you've done DCF in finance. If you did a DCF of a firm for perpetuity, and you did 5 years out and said, how much is 5 years versus how much is year 6 through perpetuity, you're going to find out that year 6 to perpetuity is probably 60, 70, 75% of your DCF value. So the market is telling us something about that. I do think that the starting point of this fixation that companies have, that quarterly kind of estimates on earnings per share, has hurt the United States economy and has hurt us like profoundly. And if you take, I've never seen this studied, but I'd love your view, Bob, but if you go back in time and say, how did we get here? To some extent, it kind of goes back to 50 years ago, that what was predominant in the United States was conglomerates, right? So these are companies that owned all different types of businesses. And it was incredibly confusing to businesses, to investors, in the way they try to simplify it down is an earnings per share number on a quarterly basis. In the kind of one of the last companies that did this was when I started in my business career was GE, like one of the best companies, not in the last 20 years, but certainly was one of the best companies. And they were the experts at this quarterly earnings per share. And, kind of moving away from that, there are some incredible examples of moving away from that. Amanda, you pointed out Google kind of moving away from it. And think about that. Google came IPO, I think, in 2005-ish. So that was kind of still the time of like that EPS was like all about. Amazon did their IPO in 1997. And it really instructive if people really want to understand a long-term oriented company. Download the PDF of Amazon's 1997 shareholder letter, which they attach to all of their shareholder letters today, still. Every year they still attach it. So there's a bunch of companies in the United States that are very long-term and short-term oriented. And I think it actually probably can break out into, this is a little bit too simple, but it's like those companies that are in attractive markets, that have a great source of competitive advantage, and as a result, they have high returns on capital. The stock market investors reward them richly, and they allow them to be long-term oriented. And you take the exact opposite. Companies that aren't in attractive markets, don't have great source of investors and they're going to pressure them on the short term, and they probably should. And then there's a bunch of companies in the middle that get swept into this and probably too focused on kind of the long term. I do think that incentive comp in the United States is certainly a flaw, and it's also kind of a big solution as it relates to this. And I fully agree with Bob that we have too many short-term metrics, even tied to the long-term vehicles of compensation. So executives, and there's another kind of paper on this that you may have seen, talk about how the mix has shifted for CEOs, CFOs, for senior executives from effectively salary to 2/3 of pay now is kind of what's viewed as long-term equity incentives, like restricted stock or stock options. The issue is that it's moved to be performance-based, and those metrics for performance-based are short-term metrics. So we need to figure that out and kind of elongate the long-term metrics of success in order for executives to kind of earn that keep. And I do think the other kind of dynamic that has happened is the tenure of kind of the most senior people needs to be longer as well. The average tenure for a CEO or a CFO is like 5 to 6 years. And you can argue pretty hardly, and it's probably a bell curve, right? Is that, there's some that are way longer, Jamie Dimon, there's some that are way shorter. You could argue that it probably should be an inverted bell curve, right? Boards should almost be like, if a CEO or CFO isn't making it in the first couple of years, they need to make that call and have a lot less people on the average and a lot more people on really long term, and they're going to think really long term about that. I guarantee you, my first year as a CFO, I thought a bit short term. My 10th year, 12th year as a CFO, I was completely thinking long term. So I think it actually kind of helps. We hijacked your questions there,
Yeah,
Zach.
it's okay. No. So first we'd like to ask, do you guys find that analysts are too focused on the short term, or do they help convey the long-term message?
Oh, I'll kind of give that. You want me to
I,
start?
sure, you
Yeah.
start.
Yeah, I actually, and Amanda, you alluded to this, but it's important for everybody to understand because this issue of quarterly earnings per share is an important thing. And it's an important pulling force in companies becoming short term. The issue is that if companies decided not to give a quarterly earnings per share target or even an annual earnings per share target, I'm going to ask this as a question to the students. Would there still be quarterly earnings per share out there? The answer is yes. The quarterly earnings per share consensus targets come from the sell side analysts on Wall Street. So these are the research firms that, are like Goldman Sachs, JP Morgan, Morgan Stanley, that have a part of their business that is dedicated to effectively putting out research reports and judgments for the buy side community to kind of have a point of view. And those quarterly targets would still be there. So I think that it'd be great to move away from quarterly targets and quarterly, in specifically quarterly consensus estimates, but we need more change than just corporations deciding not to do it. I think the act of corporations deciding not to do it is incredibly helpful. And it's helpful because when you do it, you actually attract short-term investors. The financial ecosystem is made up of long-term investors like Fidelity, like Wellington, who really think about the discounted cash flow of the business. They really think about how management allocates capital. They really think about things like culture of a company and how that translates into better business performance. And then there's parts of the ecosystem that trade on very short-term catalysts, if you will, and short-term earnings per share beat or miss. And by the way, there's been studies that have shown that can make things change on a quarterly basis, but it really has no impact on long-term value creation of the share price or the company's kind of value creation. Go ahead.
Yeah, I think there would be, the analysts will always put out short-term predictions. That's what the sell side, as Paul says, that's their job. And the question is whether management will essentially put themselves into an unviable position by either adopting or rejecting those sell side analysts. And then it becomes, if those that earnings guidance is missed, it's not the analyst's problem, it's management problem. So there always will be quarterly projections, and management just has to live with the fact that then they may or may not be right. But if management comes out and says, no, it's not $3.53, it should be $3.54, well then, whatever it comes out, then it's management's problem. And we ought to avoid that if we can.
So our next question is, what do you think we can learn from global rollbacks of mandatory quarterly reporting? Like what worked, what didn't, and how should these insights shape future regulatory approaches?
Well, as should be evident from my opening remarks, I think that the world ought to be on quarterly reporting because uh, if you really believe that reporting drives long-term growth, long-term perspective, then you would have to report only every 3 years or 5 years. And there's no one, I think, that thinks that's a good idea. So by moving from quarterly, a lot of countries have moved from quarterly to semi-annually. And I don't think it's really helped them go to a long-term perspective because then people are worried about what's going to happen in 6 months, which is short-term. So I understand why countries have done it. They're under a lot of pressure from the public companies to do it, but I think it's an unfortunate trend.
By the way, as a public CFO, I prefer quarterly. And like people are like, huh? But it is actually one of the great features of American capitalism. And even there's a big cost to quarterly reporting, what it takes to, a company to do. But we all got it, large companies have it routinized and we integrate it with our internal performance management systems and stuff like that. But it gives investors confidence. It's kind of like a low corruption index, right? Gives you more confidence. It gives you confidence that the investors' confidence that I can invest in this company because I know what is I know what's happening inside that company every 90 days.
Yeah, if you move to semi-annual, you just leave a lot more speculation in the marketplace. The analysts will still speculate. You leave a lot of what are called dark periods where things have happened at companies, but they're not quite ready to announce them. You open up, become very vulnerable to insider trading because if things happen, somebody knows they can trade on it.
So, do you guys believe that transparency and long-term thinking can coexist with each other, or do you think they're separate?
Well, who in this room is against transparency? Raise your hand. So everybody is for transparency. The question is, what do you mean by it? So I don't know. I think the premise of your question assumes that there's a very clear definition of transparency. And then the question is whether that's consistent with growth. So I think if we mean by transparency, the reporting, accurate reporting of earnings and revenue and significant events on a quarterly basis, I think that it's consistent with long-term growth. And if a company has a situation like I'm sure Paul had in a lot of biotech companies where there weren't a lot of earnings that were being produced by drug research or a drug that was in trials on a quarterly basis. But the hope was that they were going to finish the trials and it was going to be successful. They can say it. So if we really thought that quarterly earnings was in conflict with long-term growth, we probably wouldn't have any biotech companies that were public and successful because every biotech company has to take a long-term approach. It has no choice, really. But investors understand that. So the transparency here is not just saying what the earnings are and the revenue, but giving investors some sort of pathway. So I used to like to say when companies would come in and say they don't have earnings this quarter or their earnings are down because they're working on a long-term plan. Well, then I'd like to know, in how many years should I look for the earnings? What's the path forward? So I think if we define transparency as reporting accurately past earnings, revenues, events, and delineating a path forward, I think it is consistent with long-term growth.
What role should long-term institutional investors play in reversing short-term pressure?
Well, I'm in it from the institutional investor side. Just think about this, about 25 to 30% of all public companies are now owned by index funds. And index funds, by definition, are not actively buying and selling. So they're effectively stuck with with the whole market. And so the question is, do they have a long-term perspective? Of course they have a long-term perspective. They have no choice. They own these stocks and they will own them as long as they're in the index. So the question is, what role do they have? How do they bring about that perspective? And that's where you come to proxy issues. So it's those index funds are they're very diligent when it comes to what's on the proxy statement, both whether there's a change in directors or a resolution for a different strategy approach. So now, I mean, it seems to me that probably the most effective method of corporate accountability are activist hedge funds. Because whenever a company falters, whenever a company has bad performance, bad financial performance, whenever a company's stock goes way down, then activist funds are very quick to buy into the stock. And then they will have a program. They will have a program that they put before shareholders and essentially say, if you vote for our nominees on the proxy slate, then we'll put into effect this program. So what's the role of index funds? Index funds are the decisive vote in most of these activist campaigns. How many of you own individual stocks? How many of you religiously vote every proxy statement that's sent to you? I don't. And here we have a professor. He's probably an anomaly. So most retail investors don't vote their shares. But I can assure you that every institutional investor has a whole team that looks at the proxies in depth and decides how to vote the shares. And they are the decisive vote. Remember, these activist funds are not offering to buy the company. It's not a tender offer, so there's no financial reward in the short term in terms of getting a premium price. The activist funds have to sell the index funds on the grounds that if they adopt this program, if the company adopts this program, then it will increase its long-term value. And the index funds, of course, are oriented toward long-term value because they hold these stocks forever. So that's how I think they get reconciled, these two goals.
I think we have a couple minutes left. Does anyone in the audience have any questions that they would like to ask our panelists? Okay, awkward silence. Okay.
I'll get a couple here. I'll get
Oh.
Francois and then.
You mentioned wonderful stakeholders, sell side, buy side, intermediaries. Who goes first in this discourse of, let's meet somewhere in the middle? term rather than short term or long term.
Who goes from a company perspective?
Companies or the banks you work with. 'Cause
Yeah,
you've got buy side relationships and sell side relationships. And
I'll answer it from a company perspective. So let me just make sure we got the vernacular down for students. Sell side, as I mentioned, are research companies within financial firms that provide research reports to the institutional investors like the Fidelities, Wellingtons of the world. And there's a whole game kind of on this whole sell side front, and they're the ones who create the earnings estimates. If you listen to a quarterly earnings call, which is a great idea to do, pick your favorite company and just like, because you'll get a sense for what we're talking about here. It is usually prepared remarks from the companies for 30 minutes and then 30 minutes of Q&A. So it's usually about an hour long, and it's always, almost always to the sell side. And the sell side are effectively being like marketing pieces for, and companies get a little too wrapped up in the kind of sell side. I think the obligation as a CFO of a company, as a CEO of a company running a company, is way more about to the buy side, understanding the dynamics that sell side has to be kind of thought about and managed through and stuff like that. And in fact, it's even further than the buy side. The obligation for a management team is to increase shareholder value. Because the buy side, you could say, all they're doing is being agents to the people who invest for retirement, right? So I think that it is always about, and then within the buy side, we're talking about all kinds of investors that range from hedge funds, like what Bob talked about was activist shareholders, to institutional investors, and then even institutional investors that effectively are like mutual fund managers. There's different types. There's some that are like what are called closet indexers that effectively are like an index and they try to like stay really close. And then there are some that are very, very active in terms of management of their portfolio. So I think you want to focus as a company on the most long-term investors, and that's the mentality, and even go past that and think about how do you just create economic value over a really long period of time.
My question was probably too big for the last few minutes, but I wanted to just point out that
Can we grab a mic? 'Cause it's like-
financial reporting frequency is a byproduct of being public. And the other debate is some people will say that being private is more long-term oriented. So do you have any thoughts on private versus public financing?
I mean, but the starting point of that is like, well, there's been a huge trend in corporate America towards delisting, right? So public companies actually kind of a lower number of public companies being traded on the kind of stock exchange. But that's a bit of a function of consolidation in industries, and it's a bit of a function of private equity that has gone way up. I think the starting point for me is private equity more long-term oriented than companies who are publicly traded companies? I think it depends. Sometimes they are, sometimes they're not. I mean, their model is 5 years, right? But their model is to have a more valuable company after 5 years to go sell, right? So private equity is about buying companies after 5 years. Their investors think that after 5 years, we're going to sell that company, plus or minus, and we want to sell it for a bigger exit. I think that they've become better at operating companies. They're a very good model of how to operate a company in specific types of industries. So, yes.
Well, I think that's all the time we have for today. I would like everyone to join me in thanking our panelists for taking time for us.